Are we live?
Yep, go ahead. Take it away.
Hi, everybody. Welcome to our Established ESOP Forum. It's April 23rd. Thanks for joining us today. I have a wonderful group of panelists to dive into a topic that we had chatted about in the last forum. Um, Today, what we're really looking to do and accomplish in this hour that we have together is dive into repurchase obligation, repurchase liability a little bit deeper and actually talk about specific strategies, tips, and options for how to best plan for repurchase obligation. Some of you are fresh on your ESOP journey, and this may be very new to you. Others may be well seasoned in their handling, and you may have already done some of these repurchase buyouts as you buy out your employees as they leave or are otherwise eligible to receive those benefits. And those strategies that you employ in day one may not be the same strategies that you employ later on. So really excited to have our professionals here setting the stage. We have Kirsty Corey, Brian Lean, Jeff Jamarino, Steve Goodman, and Joel Davis. You'll hear from each of them and their roles. I'll have each of them introduce themselves when they first launch their topic. So really appreciate everybody joining. And what I'm really going to do today to start is turn it over to Joel Davis, as he'll tell you. Joel is a TPA at Principal Financial, and Joel can kind of help us set the table as we start our journey into strategies on repurchase obligation. Joel, take it away.
Thanks, Josh. Yeah, and I guess I won't introduce myself because Josh just did. But it's good to be talking. Good to be talking with everybody. And like Josh said, last session we talked about repurchase obligation, talked about things like repurchase liability studies and sustainability analysis and the different things that feed into that. This time we're going to get a little deeper into things like distribution policy, what your options are, some different funding strategies, kind of take it to that next step. And in the work that we do, really all the advisors that are involved in an ESOP transaction have some role in this. Part of what we're trying to do is set the company up, the ESOP up for success long term. And one of those things that principal, when we're doing analysis, what we take a look at is we know we're going to have contribution requirements related to this ESOP loan. And ideally, we would like to leave enough room for contributions to be made, at least for a foreseeable time, to give the company flexibility in how they handle the repurchase of shares from participants. And you'll hear as you go to ESOP conferences and talk to your other advisors an awful lot about the 3 R's, which I look at it really as the first 2 R's kind of as a spectrum. On one hand, you have the recycling of shares, handling. Yeah. I'm sorry, I thought I heard something. Handling the repurchases through recycling shares, which is essentially we are putting extra cash into the plan. Generally, it's contributions. Sometimes it might be dividends or S distributions. And we're using that cash to essentially buy the shares back from the participants inside of the plan. So the participant getting a distribution gets cash. The other participants in the plan get the shares that were repurchased from the participant. So recycling on one end, the other end is redeeming. And that essentially is where the distribution from the plan is in shares. And in most cases, those shares, the participant might not even know that they had a distribution in shares. As soon as they get the shares, they're required to be sold back to the company. Then that participant gets cash. In either way, most cases, participants getting cash, it ultimately ends up being how the company is handling those repurchases, whether it's contribution or dividend into the plan or not making an extra contribution or dividend and handling it really just the share repurchase between the company and the individual participant. And as ESOPs mature, we see early in an ESOP life cycle, a lot of recycling because it's simple. Just make a bigger contribution. We're going to use it to recirculate those shares. But as the repurchases get larger and larger, oftentimes that doesn't suit the company, or they can't get enough of a contribution into the trust. And so we start looking for ways to either blend those two approaches, or in some cases, as ESOP gets real mature, there are cases where we re-leverage and basically create a new ESOP loan and spread those shares out over a long period of time as they're being repurchased. And many of these things will be touched on as the other advisors are going through their pieces. The next, I'm going to turn over to Kirsty Corey to talk more specifically about distribution policies.
Yeah, thank you, Joel. So my name is Kirsty Corey. I have served in a trustee role, so serving as trustee for ESOPs for over 26 years now. And so I get to see a lot of techniques when it comes to solving that, repurchase obligation / sustainability issue. First, I'm going to apologize. I am not in my office today, so the kind of bright background you see is that of a hotel. So hopefully that's not too distracting. But I wanted to spend a few minutes just talking about distribution policies. The distribution policies are really, it's a document that's kept outside of your ESOP plan document to really explain in layman's terms and give you some flexibility on how you manage your distribution process each year. Typically what is nice to see, and hopefully you're all familiar with your distribution provisions in your plan document, is just the statutory distribution provisions in the plan. For example, 5-year wait, 5-year payout on normal terminations, maybe 1-year wait, 5-year payout on death, disability, or normal retirement. So in your plan, ESOP plan document, it's nice to have that ultimate flexibility that is allowed under the law. But a lot of our clients, especially when they do go through a repurchase obligation or sustainability study, say, hey, we don't really want to wait 5 years to pay our normal terminees and then pay them out over 5 years. So that's where that distribution policy comes into play. That distribution policy gives the company a lot more flexibility in being more lenient towards the participants, maybe paying out sooner, which could also help the company achieve its goals of hopefully making those distributions a little bit cheaper if you pay them out sooner versus waiting when the stock price grows and paying them out later. So that's just one example of something that a distribution policy can address. But if the company runs into, let's say, cash flow crunch, or even hard times, or possibly you want to do an acquisition and you have other uses for that liquidity, you can always revert back to your plan document that says, hey, you really do have a 5-year wait and you can pay out over 5 years. So if you need that flexibility, you keep that in the plan document. I do want to caution, I think it would be perhaps catch some attention if you're wildly kind of amending year over year that distribution policy to very different things on a year over year basis. That probably would catch the attention of your participants. So for instance, you said, oh, we've decided instead of waiting 5 years to pay people out, we're going to pay everyone out lump sum in the following year, and then change that to like a 4-year wait and a 5-year payout the following year. Participants talk, so that could create some confusion on their part. So I think you really need to really think through what your distribution policy says, make sure it makes sense, and also make sure you're not setting some sort of precedence with your participant base. Some of the other things that the distribution policy can address are the number of installments I did mention. So instead of maybe paying out over 5 installments, you want to modify and pay out over 3 installments, but keep the flexibility in your plan document if you ever do need to go back to 5 installments. Another common thing we see distribution policies address is the lump sum threshold. So a lot of documents say if the distribution is under $5,000, we're going to pay out lump sum. Perhaps you have the cash and want to pay out sooner your distributions. So it's not uncommon for companies to say, hey, we're going to move that lump sum threshold in our distribution policy up to $20,000. But again, that's in the distribution policy. You're keeping the flexibility in the plan document in case you ever have to go back to a lower threshold. Sometimes the form of distribution gets addressed in those distribution policies. I think Joel, mentioned that a lot of times initially a plan is just recycling shares. So the distribution is in the form of cash. For any of you that maybe more ESOP or perhaps are distributing shares or shares and stock and cash to the participants as part of their distribution, that could be something that you address in that policy as well. And again, the other thing that I touched on initially with the kind of example is that if you would like to start your distributions sooner than otherwise allowed in the plan document, that the distribution policy is a great place to address that as well. So I'll kind of pause there and see if we want to move on to the next topic, or perhaps any
that's great.
Questions, Josh?
Yeah, I was actually just wondering if you could help chime in on, and Jeff, maybe this is something for you too, or really anybody, Steve as well, and Joel. How often after the ESOP do you typically see folks first put this distribution policy in place? And then you would hit on it a little bit, Kirsty, in terms of culturally, you might not want to change this document, every year and kind of swing people back and forth. But how often what do you generally see? I'd love to get some insight on those pieces. So Kirsty, maybe we could start with you and see if anyone else has anything to add.
Yeah, so it's kind of all over the board. Some clients never adopt a distribution policy. They kind of run with what's in their plan document. Others will do it right out of the gate with the brand new ESOP. They'll deliver the plan document to me in draft form, and they'll say, oh, by the way, here's a draft distribution policy. So those are kind of the two opposite ends of the spectrum. And then, I think what's fairly natural for most clients is they kind of, 4, 5, 6 years down the road, they start paying distributions and they start thinking about, wow, maybe we don't want to do what the plan document says. We kind of want to clear these, people out of the plan a little bit sooner because the balances are small. So that's usually when I see most clients start to think about a distribution policy.
I would echo that, Kirsty. That's what I've experienced in the past and seen from other companies, is that most of the time they kind of have to get a feel for it first before they're ready to take that step and actually set a policy. I have seen companies that, as you said, do it right away, but most people are so uncomfortable at first just with everything that's going on with the ESOP that they're afraid to do something that might influence what they want to do later on, and so they tend to wait a few years before they set that policy.
Steve, you might be trying to speak and you're on mute.
How could you mute a lawyer? I don't understand.
I know. Apologies.
No, we're kind of the same way. We try after 3 or 4 years. We try to get it right up front, but after 3 or 4 years, we usually sit down with the client and kind of review a lot of the terms of the plan. And we talk about them doing a repurchase liability study and talk about distributions, and to make sure things are going right. Because as Kirsty said, after 4 or 5 years, that's when you really start seeing the distribution start, and we want them to be prepared for that.
Thanks, Steve. Good stuff. Yeah, I mean, distribution policy, very important. I think on the front end, as we see ESOPs get established, I mean, I agree with kind of what I've heard. I think really only 1 or 2 times have I seen a distribution policy really get put in place, either as part of closing or very shortly thereafter. But an important document, to be looking towards and have that first line of flexibility. So good stuff. Maybe what we'll do is transition now. You heard about the distribution policy giving you that front end flexibility. Well, let's actually talk about specific ways to fund and pay out those benefits if paying out in cash. A lot of different strategies out there, and want you to hear from some of the different professionals about some of those strategies. What I'll do now is shift it over to Jeff Giammarino, who can formally introduce himself. You heard from him a minute ago, and he's going to talk about what we generally refer to as pay as you go, and give some insight into when that might be an advantageous way to fund repurchase obligation. Jeff, please take it away.
Yeah, thanks, Josh. So my name is Jeff Giammarino. I work for Lazier Capital. Prior to my joining Lazier, I ran an electrical contractor for many years that was an ESOP, and we experienced a lot of the things that we're talking about here today with distribution policy and funding and all these conversations we've had in the past, and so I'm happy to bring a little bit of practical experience to our conversation today. Pay as you go is the most obvious, and it's the easy one that everybody, I think, in general tends to fall into in their first few years as an ESOP, right? I mean, it's just the numbers are very small. There's just not a lot of pressure to really look at that funding strategy, other than we'll just pay it as we go along. It shouldn't be a big deal. That's the natural human tendency to do that. What you'll find, though, and what we experienced was probably a couple of years in, and we had a slightly different vesting policy than a lot of companies adopt. Ours was much quicker, and so the repurchase obligation became more important a little quicker than it might in other companies. And so that's, I guess, maybe the first thing I would say to everybody is, if you've got a 6-year vesting, the need for figuring out how you're going to fund this and how you're going to deal with your repurchase obligation may not come up quite as quickly. But like in our case, we had a 3-year vesting policy. That vesting happened pretty quickly, and pretty soon we needed to do a repurchase obligation study to find out what our obligations were looking like in the next 5, 10, 15 years. And so that's what we did, and we recognized that, yeah, there's some pretty significant needs for cash that were going to arise, and we needed to address it. We did take a pay-as-you-go approach. I know we looked at some of these other options that we're going to talk about, but at least during my tenure, we didn't go there. Not that they're invalid or not good. There's reasons for doing each of them. So our focus was primarily on preserving cash. Josh, I think you touched on it earlier. We wanted to have that cash available to us. We were on a growth trajectory. We wanted to make some acquisitions. We didn't want to have any cash leave our balance sheet that didn't absolutely have to. So we took the pay-as-you-go approach, and in essence, what we did was we started taking, in our case, we took about a third of our EBITDA each year and started setting that aside in the following year as funding on the balance sheet that we were setting aside to be able to meet our repurchase obligations as we went along. And we knew that it was there. Yes, it was set aside for repurchase obligation, but it was also available to us to use for other purposes in the short term as we needed it. And quite frankly, what we ultimately did was we built an investment portfolio, and if we had wanted to, we could have even borrowed it against our own portfolio in order to fund some of those other transactions. The principle of how we operated that was we actually went out and found an investment advisor that was very familiar with like pension funds, and had actually worked with some of the union pension funds that we were familiar with and had done a nice job for them. And so we went to them and said, look, we basically need to build a pension portfolio that will, take investment returns and match those to the future obligations that we're going to have. And we shared the repurchase obligation study with them so that they could make appropriate investments based on our needs. And so every year we had additional funds that we set aside, and we started building a significant investment portfolio that became very diverse and looked very much like a pension portfolio would look. And we managed that actively, and it was working very well for us. But I can see on the flip side, I understand why there would be other reasons for doing other things. So that was my experience. I will say that most of the clients I work with now in the early years are on the same sort of path where they're just doing pay as you go. And but I think as the pressures build on repurchase obligation, people will look at alternatives and try and figure out the best method for them.
Thanks, Jeff.
Absolutely.
Good stuff. Before we move on to other ways of planning, Kirsty or Steve or Joel or Brian or anyone, any commentary on what you typically see in terms of how many clients would do pay as you go, maybe, sinking funds or other on balance sheet investments. Happy to open the forum and see if others want to layer on to Jeff's insights.
Yeah, Josh, one thing I'm not going to talk specifically from a funding strategy, but maybe more something that Jeff said about sharing the repurchase liability study with their investment advisor. I think that the tendency is to do those repurchase liability studies only when you have to, or after the dollars start to get big. But I think doing them, starting them after the first couple of years and doing them on a regular basis, it layers into everything that we're going to talk about as far as understanding what your options are, but then taking a look at what funding vehicles are feasible for you. That really is foundational in all of this.
Well,
Joel, I'm sorry. Go ahead, Kirsty.
Yeah, I was going to say, I totally agree with what Joel said, and Jeff, your experience, that you had is very similar, that even no matter how much we talk about different funding strategies for the ESOP and have over 26 and a half years, I'm going to say as high as 80, it might even be 90% of companies I work with, it's a pay as you go strategy. And so are they thinking about, what the obligations are year over year and doing maybe some sort of at least mental thought process of here's what we have to put in the ESOP? Yes. It's not that I haven't seen the sinking funds in the balance sheet, saving within the plan, et cetera, but it is just the majority of folks that I've ever worked with is it's adopt a pay-as-you-go strategy.
A couple things I want to point out as well, related to a pay-as-you-go policy, just so that it can be compared and contrasted to the other funding methods that we're going to talk about, is one, if that portfolio sits on your company's balance sheet, that's obviously going to drive the valuation of your company higher, as opposed to getting it off of the balance sheet. So, keep in mind as you build that portfolio, and ours became pretty substantial over the years. It had an impact on what our share price was, which means that your repurchase obligation is even going to become higher because your valuation keeps going up. There was always an argument that, well, gosh, if you move the cash into the trust, then from a participant standpoint, the cash would now be protected, and even if something bad happened to the company, our value, at least a portion of our value would be protected within the ERISA trust, and we'd have something to show for it. But the flip side to that to keep in mind is that once you put that money into the trust, there's no getting it back out. So if we did want to use that cash later on for acquisitions, for growth, or anything else, it was no longer available to us. So just those are points to keep in mind as we compare and contrast these other funding methods.
Thanks, Jeff. And good input from everyone. And be curious if you're listening in, even chiming in the chat box, kind of curious if folks do pay as you go, or as you hear about some of the other things we're about to discuss, kind of curious what the participants on the call today do, if anything. So maybe with that, we can transition a little bit, and I'll turn it over to Steve, who can talk a little bit about some more nuanced types of investing that he's seen before. And Steve, why don't you take it away, and we'll start the dialogue there.
Well, first of all, Jeff's exactly right. I always found it ironic that you set up a sinking fund or some investment account for the purpose of covering your repurchase liability, which has the effect of increasing your repurchase liability. So what we do with a number of our clients is we set up these, what we call repurchase liability trusts. And in effect, the company would go and set up this irrevocable trust. And the purpose of the trust would be to cover repurchase liability. The company would make a contribution to the trust, and the monies would go into the trust, they'd be invested, and then when the company needs the monies to pay out benefits, they'll make a claim. And we have an independent trustee that manages the trust and oversees the trust, and they would make a claim and say, we need to pay out this amount of repurchase liability, and the trust would then return it to the company. Since it's an irrevocable trust, it has a number of benefits. Number one, you've got, since it's inside an irrevocable trust, the company cannot get it back. It's not an asset of the trust, and therefore the valuation firms won't take that into account in terms of setting the value. Number two, it's asset protection planning. So if the company does get sued, those funds are safely set aside for the payments to participants. We do have a backdoor. So if the company can prove to the trustee that there are sufficient, they can do a pay-as-you-go, or they don't need those funds can be used in effect to cover other employee benefits for the company. But it can never be returned to the company to sit in its coffers and be used for non-employee benefits. Okay. There are a few negatives. Number one, it's a non-qualified trust, therefore it's subject to income tax. So the trust pays income tax on its benefits, on its income. Number two, since it's a non-qualified trust, the contributions are not deductible to the company. Okay. The third one is what you're doing is, and this is something that's always kind of been in the background, but you have to be careful because you are reducing the value. We're doing exactly what Jeff said, is if we had kept it inside the company and invested, we'd be increasing the value of the ESOP participants. Here, we're moving it outside, and it's not impacting the value. We've had 3 of these audited. Well, 3 of the companies audited, then they looked at these trusts, and we haven't had any problems. They didn't raise any concerns. But we always are trying to balance the security of having those funds over there to cover the repurchase liability for the participants, with the fact that we're reducing the upside for the ESOP participants. But that's the way the way that we've worked the trust, and it's worked pretty well for a number of our companies. And again, inside the trust, we need to talk about the same types of investment vehicles that Jeff talked about and Brian will be talking about in a second. So you could pick and choose which way to invest that money. But again, it's that's kind of the purpose of the trust, is to get the best of all worlds in terms to be able to remove it from the valuation, provide security for the participants, protect it from creditors' claims. So anyway, it's worked out very well for a number of our participants.
Hey, Steve, just to clarify maybe for our listeners, and quite frankly for myself as well, what's the advantage of doing the trust that you just described as opposed to just putting the funds directly into the ERISA trust and avoiding paying income tax on anything?
Well, I think it's just what you said is, when you put the monies in the trust, then people's account balances share in those funds. So in effect, you're increasing repurchase liability, because when those people leave, you have to cover those funds. And so we're careful to work with the valuation firms to talk about, what amount is needed to get in there, so that if it's ever questioned that we've overfunded or did something to harm the participants, we can say that it's clear that this is the amount that was needed, and we're concerned about security for the participants, and that overrode the possible increase in the value of the company.
All right. Thank you, Steve.
Good question. Other thoughts? This was new to me as well. I think a really unique way to try to tackle repurchase obligation. Steve, sounds like you've done this a few times. What were you seeing prior to kind of creating and helping figure out this solution? What were you seeing most of your folks do? Was it the pay as you go, or were some putting money into the trust?
Kirsty's right. And most of 80% of our clients are doing pay as you go. The scary thing is, kind of to follow up a little bit on what Joel was saying, several times when we got into how they were investing the money and everything, they were not really working with qualified investors, so to speak, people that understood how the money needs to be invested conservatively to make sure it's there. And we were surprised to find some investments in there that we thought were probably not a good idea. And so I think you do need to be careful whenever you do set up one of these funds that, as Joel said, you lay out, this is the repurchase liability, and needs to be invested very conservatively to make sure we get to that number.
Wonderful. Thanks, Steve. Why don't we transition? I think now's a good time to transition to Brian and Sam to talk a little bit about some unique kind of investment options, primarily the use of unique COLI product to help satisfy repurchase obligation, or at least assist in the evaluation of retirement planning. So Brian and Sam, do you want to have one or both of you introduce yourself and take it away?
Yeah, thanks, Josh. Yeah, Brian Lean, LS Benefits Group in Ohio. Been working with Josh for a couple years now. Sam is out of Columbus. He's one of my partners. So really kind of cool. So our world, I work with small businesses all the way up to very large companies. Our world is COLI, acronym for corporate owned life insurance. And so I was listening to Jeff, and I think it's really interesting because it's really in the same world, Jeff. What we do in our world is build portfolios. We are not going to be the entire portfolio. What we try to do in the COLI space is come in on the fixed income portion, not the equity portion, the fixed income portion, the safe, the guaranteed world. When I say institutional, we use very, very high cash value products in year one. So there is a very big difference. For everybody on the call, there is traditional life insurance and there's institutional COLI. You got to know the difference. What we use is high on the balance sheet. Corporate America, Fortune 1000 companies use it. I go into a situation like Jeff explained, and I teach people, here's a portfolio of X number of dollars. In that portfolio, we've got a portion in equities, we got a portion in bonds. We take a portion, typically 10 to 15% of that cash, and we implement COLI, and we put the cash value on the fixed income portion. But what it also comes with, which is very unique to the portfolio, it comes with death benefit, and it comes typically with death benefit on our key people. So it does two things. One, it protects an unforeseen death, so that if something happens to somebody, we have an instant buyout provision in there because of the death benefit. It also is a cost replacement for our key person. So if somebody is super valuable to the company, which most of the time you have those people, we now have the ability to replace it with that. So COLI is not the end all, but I'm pretty certain COLI is a great asset for a portfolio of people that are building. But it's not everything. So for us, my job is to teach people how to use it, how to build it into the portfolio, what percentages to use. And just like I think, Jeff, you talked about borrowing. COLI if the right COLI is really easy to borrow against. It's really easy. You put it up for collateral assignment, you leverage it through loans, you can do it internally with the insurance company. And by the way, there's only a few companies. I have searched the country for the best products. There's only a couple really good products out there. But when you find them, they're really good. But we leverage that cash. So for Jeff's point, when I see a business opportunity it doesn't have to be for that repurchase obligation. I can leverage it to expand the business and turn around and pay it back or not pay it back, whatever I borrow. But I don't lose that death benefit portion. So for my allotted time, Josh, that's about all I can give today. But it's a high level view of what COLI does and how it works. So appreciate that.
No, thank you, Brian. I think I've loved, obviously we've known each other a few years, love the product you bring and helping folks understand that not all COLI is created equal, I guess, is one way of saying it. Others, are you seeing COLI type products, come through over the years? Jeff, did you ever implement any of those or think about those strategies?
Yeah,
Joel,
we definitely looked at it. It was a conversation that was on the table when I ended up retiring. But we as our portfolio was expanding, and Brian, you touched on it. The need to diversify our portfolio appropriately is really what raised the COLI conversation with us. So it was an avenue we were going down, and it is a very viable and legitimate way of providing some additional diversification. I mean, even equity and fixed income products can be very limiting if you're strictly buying on the market, and that you really as your portfolio grows, it's not, things like COLI, things like alternative investments may be appropriate. You need to work with your investment advisors to figure that out, but you've got to have the appropriate balance. You don't want to be 100% in the market and all the ups and downs that the market experiences. And it used to be that we could count on, if bonds were down, stocks were up, and vice versa. And more recently, I guess it's been proved that both of them can move in the same direction at the same time. So additional diversification is really critical.
Yeah, Jeff, and real quick, I mean, I think that's where, from my standpoint, and Josh, you said it best, not all COLI is created equal. In fact, most COLI is not good. Most products that are being distributed out there are not really great inside of the ESOP world. I found a couple that really make sense because of that first year cash value being almost 100%. So you don't have those high loads. To me, that's how you build the portfolio the right way for folks. And I think, that's something as you grow and expand, you can learn more about how cash can be positioned inside that portfolio. So, and the other thing is advisors, typically your investment advisors are not COLI experts. So the instant comment is going to be, well, it's not good. So, because that's not necessarily what they offer. So, that's always the side note, is really understand, why big companies use COLI.
Yeah, I'd say too, Josh, that because we work a lot with investment advisors, and they would get excited because they'd read an article on funding repurchase obligation using COLI, and they would run out there and they would tell the death benefit, the not being taxed and things like that, and not understanding the nature of a lot of the companies they're talking to that are 100% ESOP owned. So I definitely say, working with a firm like Brian's, where they understand the ESOP structure as well, and that you're buying the right thing for the right use.
And got a question in the text box that I'll throw out maybe to Brian or others. If COLI can be used as collateral for other purposes, how is it not at risk? So maybe a bit of a general question. I mean, I think having that high cash value, helps kind of minimize the risk. But, Brian, didn't know if you had any other kind of thoughts.
I don't know if that question's referencing Steve's world in the irrevocable trust or just the general. I know it. We can put it in Steve's world to protect it. That is an option. Or it's only going to be on the general balance sheet. We're not putting it in the trust of the plan. So.
Yeah, Brian, as I read the question, I think what they're asking is if you buy this product, right, and it's an investment that you're trying to use to build a portfolio, I think what the person was asking is if you go out and borrow against it, then what do you really have? And I think the answer, and you correct me if I'm wrong, but the answer is even if you've borrowed against the cash value of the policy, you still have the death benefit in place, which is unique compared to other investments.
Yeah, we do that all the time. I mean, I work with non-ESOPs, and it's a matter of leveraging, but the whole time that death benefit stays in play. And when you, especially early on in the policies, there's a substantial difference between cash value and death benefit. You might have a $10 million policy and $1 million cash. You leverage the cash, you go double the cash with the business, and you still have a net $9 million of death benefit on your key people. So, and then one more thing I forgot to say, I get excited about it, but we can also set up through PS 58 cost strategies where employees, we can actually co-beneficiary those policies. So we can create executive benefits around that death benefit. So if we had a death benefit of $1 million on one of our key people, I can split beneficiaries to do 250 for a family and 750 for the repurchase obligation. So you can do a lot of different things. Most people just don't even understand it because it's just not on the forefront every day. But it's really, when I go back to Jeff, your portfolio, and putting in, a 10 to 15% position in COLI, in my mind, it's a no-brainer. It's the people that get into putting 100% into COLI. I'm not into that. It's still about balance. It's still about having multiple. I don't ever think there's a right or wrong answer to any of this. My opinion is balance, balance, balance. Give yourself choices on what you want to draw from when you get there. And the more choices you have, the better position you're going to be. There is no right or wrong answer on this call.
Yeah, and I think I just have two follow-up points to that. I think, whether it's a COLI policy on the balance sheet or it's just a sinking fund, if the company needs to pivot and use that cash for something else, that's kind of the beauty of why it's kept on the balance sheet and not put in the trust. So, it's always possible that, hey, you thought you were going to use it for repurchase obligation, but maybe you don't. Maybe there was an acquisition or some other cash need that the company needed those funds for. And then Brian, I guess with respect to your comment on, I love the concept of creating, executive benefit around the COLI. And I'm looking at Steve Goodman. He just can't tell that as the attorney. But in the land of S Corp ESOPs, would that be considered like a split dollar life insurance policy, or would that be something that you'd have to consider for purposes of the 409P test? I don't know the answer, but it's just a thought.
Yeah, I was actually thinking the same thing,
Yeah.
Chastity, that I think it might fall under the 409P testing.
Yeah. And so you very well may be able to use that strategy because, again, I like the concept, but you just want to make sure that the 409P test is not impacted in a way that would be detrimental to the company.
So work with Joel or your fellow TPAs before you formally award those, because I tend to agree. I do think it would fall in 409P land, at least through my understanding of it. One thing I had, not specific to a certain strategy, but who decides this stuff, right? Jeff, in your situation, did you have an ESOP committee? Was it upper management? Kind of how often? Give me a little lay of the land in terms of how and when you're starting to think about this stuff and who.
Great question, Josh. And you're right. We did have an ESOP administrative committee that was focused on things like repurchase obligation. And from that committee, we then created a subcommittee that was strictly responsible for managing and building this portfolio. So that committee usually met 4 times a year, and in our case, we were using Morgan Stanley. And the folks from Morgan Stanley would come in and we would talk about, hey, what are our upcoming cash obligations? How much cash are we going to add to the portfolio this year? How else can we diversify our portfolio to match our needs and our goals? And so that subcommittee would actually meet at least 4 times a year to discuss those things. And then Morgan Stanley, we always left a standing order with them. Look, if something happens in the market in between quarters, don't wait for the next quarter. Call us and we'll convene a meeting and have that conversation immediately if we need to. So it was actually probably one of our most active committees.
Steve, what do you see? Is that pretty consistent when you're advising clients? What do you like to see?
Yeah, usually, remember, the obligation is on the company to do the repurchase. And so For smaller companies, we have the board of directors that actively review the repurchase liability. And for larger companies, we set up employee benefit committees, ESOP committees that take the lead. We recommend that they get someone in the committee. They don't have to be employees, people in the company. You can bring somebody in from the outside who maybe has some investment advice that they could provide. Because again, I think that's key, whether you're going with something that Brian suggests or some kind of pay-as-you-go strategy, the money still has to be invested somewhere. I realize not for pay-as-you-go, but for a sinking fund approach. And there are certain ERISA approved benefits and certain non-ERISA approved benefits, and you've got all the standards of diversification, and you need to follow those rules, or you expose yourself. If the IRS or Department of Labor come in and audit and the market takes a dive, are they going to be looking at the fiduciaries and saying you didn't diversify or you put it in some unwarranted investment?
Yeah,
Go ahead,
I think
Joel.
that's a great point, and I've been thinking about it ever since Jeff said it. In the selection of their investment advisor, somebody that worked with institutional pensions and understood time horizon, and we saw this pretty dramatically a couple of years ago when, especially in cases where plans had large amounts of segregated participants, and in some cases those participants could take distributions. In some cases they were still waiting, but they were not substantially in company stock anymore. And in the market, when it's on a good run, you're looking pretty smart by having those assets invested, whether it's a 60-40 split or whatever measure you want to use. You have a down year, and they were having to explain to people how their segregated accounts, could lose value of 15 or 20%. And it really, came back to the people that were making the decisions about the investments. I think we're largely ignoring the time horizon for needing that liquidity and making sure that they were protecting those assets. So making sure, in the case of Coley with Brian's firm or the investment advisor, if you are investing, especially investing inside of the trust, which is the case I was talking about, that you're using professionals that understand that repurchase obligation and what that means to the time horizon of needing that liquidity.
Joel, to your point, that's exactly why we selected who we selected, because of their knowledge and background with pension plans and successful pension plans. So that was that, and as you said, the time horizons, understanding, okay, some of this cash we can be a little more aggressive, go after some returns because we don't need the money for 15 or 20 years, but we know that we're going to have obligations coming up and we have to buy and sell appropriately based on what those upcoming obligations are. A couple of things that Steve touched on that I want to touch on also real briefly. He mentioned board of directors potentially on an investment committee, and we actually did have a couple of our outside directors that participated in those investment committee meetings that we had. So it wasn't just internal management that was doing this, but we did have some oversight from our board of directors as well. And that I think that was very important in maintaining the overall objectivity of what we were doing. The other really important thing that we did, and we worked not only with our attorneys, but also with Morgan Stanley in creating an investment policy. So we had a very clearly defined investment policy that described what our goals were, what we were trying to accomplish, and what investments we considered appropriate at what levels, and we had ranges set for different types of investment categories. But having that policy in place, I think, was an important step towards protecting us to demonstrate that that we were doing the appropriate things to make sure that we were diversified and protecting the assets of the participants.
Fantastic. Matching the assets to the liabilities. That's just my CPA auditor days. Very helpful. And I know, some of it is just who makes these decisions, right? And how does this work? So Jeff, you're, hearing from you and Steve on how you typically see, who's making the decisions, board, separate committees, I think is helpful as folks are particularly in the early years of the ESOP and sort of just getting up and running. Any questions? I'm checking the chat box. Would love to see if you have more questions. Are there other strategies that you have heard about and were keenly interested in that you'd like to hear from the professionals here while we have them, on the line? Feel free to
Josh,
put them.
while we're waiting for questions, I just want to say that, and I'm sure I speak on behalf of all the panelists today, but if anybody wants to reach out and have further discussion on whether it's my personal experience and what I, in the pay-as-you-go type environment, or talk to Steve or Brian or anybody, I'm sure we'd all be happy to field your questions or conversation if you want to do that later on.
Well said, Jeff. I think as people, think about today's, meeting, they may go back to their committees or go back to their TPA or their lawyers and start asking, and that's good to just ask around. And to your point, Jeff, all the professionals here are available. Let us know what questions you have. We would love to help be part of your ESOP journey as you head into the repurchase obligation land. Other comments? Thoughts?
I think there's a.
There we go.
Oh,
We got a question. There we go.
Yeah, I was gonna say, I think there's a question.
What is the role of the trustee in guiding the company, especially newer ESOPs in this area? That's a great question. Jeff or Steve or Kirsty, I mean, you're a trustee. Maybe you're a great person to start with. Should we be coming to you, or should we do this behind your back?
I think it's definitely come to the trustee, but this is something I think about out of the box from the very beginning. The plan document provisions are plan sponsor function and responsibility and role, but I do not hesitate to raise my hand if I think that one of the provisions that perhaps they select, like maybe immediate lump sum distributions, I've had to raise my hand and say, "Are you sure you want to do this? Because here's what can happen down the road." I remember probably 20 years ago, a whole bunch of practitioners got in a room and said, "Whose responsibility really is this?" And of course, I believe it was Steve that said it really is a plan sponsor function to satisfy repurchase obligation. But as a trustee, I cannot be blind to it. And it's probably one of the biggest focal points of myself and my group is repurchase obligation and sustainability, because a lot of times, companies, they're trying to run a business. They don't know what they don't know, and things might be fine today. But we kind of have this, ability to look under the hood and think that perhaps there could be some issues down the road. So we always raise our hand, engage in conversation, and ultimately, if there is a repurchase obligation or sustainability problem, even though it's the company's responsibility to manage that, it can very quickly become a trustee problem. So it's kind of this joint approach.
Yeah, and from my standpoint, Josh, just like a lot of other things that happened, my approach always was I always kept our trustee informed, right? So our trustee knew what we were doing and what our approach was, whatever the subject was. But in this particular case, we told them, hey, we're building this portfolio. Here's what we're doing. The response was, as long as you're, keep me in the loop, as long as you're doing what's appropriate. Lean on your board, lean on your committees to make the day-to-day decision making related to this. I do, as a general comment on this whole subject, I do want to point out this is really a relatively complex subject related to ESOP, especially as your companies mature as ESOPs. And we didn't even really touch on, why you do redemption or recycling, or why, and the funny part is that when you pull one lever, it has impacts on other things, and we really haven't even touched on that today. It could be a whole nother conversation to have somewhere down the road, but understand that these decisions that you make don't happen in a vacuum, that they have other impacts on your on your plan that you may not have thought about. So it's always good to talk to your professionals when you're thinking about some of these decisions.
Yeah, and I think it can be a very frustrating process sometimes to move through for that exact reason that you just stated, Jeff, is that you feel like you plug one hole in the boat, you have a good solution, but you spring another leak. Because it's not just 1, 2, 3 levers you can pull to try to help with sustainability and repurchase obligation. There are like, 8, 10, 15 different things that you could potentially do in conjunction with one another.
Yeah, and that even really gets back to, going back to Joel and that and the TPA and the testing that they have to do. I mean, some of those impacts are related to the testing that has to be done at the end of each year. And so, you need to be cognizant of those choices that you make so that you're doing the right thing and you don't get yourself into trouble somewhere else within the plan.
Steve, any last comments from you? Generally consistent with what you've heard?
Yeah, I think I agree with everything they've said. And one of the things we do have 2 or 3 clients that are using these repurchase liability trusts to kind of make it more attractive for the participants. Some of the participants are worried about, well, where am I going to get my money when I'm ready to leave? And, I've got stock in my account. What if the stock goes down? And they're using it as a backup to say, well, we're funding it over to the side and in a special trust. And so to make sure that when you are ready to leave, we're going to have those funds available.
Great comment, Steve. I like that. I think that gives people a lot of comfort knowing that there's proactive planning going on. Well, with that, we have about hit the end of our hour. I thank you all very much. If you have further questions, please do not hesitate to reach out to Danny or the group. We will work to find you the answers that you need. You've got a great group of professionals here who would be happy to talk about your specific situations and desires for repurchase obligation, and look forward to upcoming sessions. I think our next session is in June. We'll share topic here in the near future, but very excited to continue this established ESOP forum and picking topics that are relevant for new and more mature ESOPs. So thank you all very much.
Thanks, Josh.
Thanks.
Bye. Thank you.